We're going to talk about banking. Interesting subject, the banks getting into the crypto market. They were so hostile for so long, but that's changed, right? But first of all, let's just introduce our guests. Mohil, Subban. You just give us a brief background, 30-second background, and then Rikki Barnes, you the same.
Thanks, Ciaran. My name is Mohil, part of the PwC Tech Consulting practice. I spent between 5 and 8 years in banking, financial services, and the last 7 years in tech consulting, from tech strategy all the way down to implementations. At the moment, we try our best to lead emerging tech and innovation consulting go-to-market.
Hi, my name is Rikki Barnes. I head up a blockchain enabler team for FirstRand. I've been in financial services for almost a quarter century. But this has been the most exciting last 4 years of my life. And yeah, I've been able to take learnings from across many different fields and try to improve upon financial services by integrating blockchain technology and digital assets.
Thanks. All right, so we heard quite a lot about stablecoins today. We heard a lot about the encroachment of crypto rails into traditional finance. Rikki, I want to start with you, with FNB. And I did say they were hostile, and it's true, they were. The banks were quite hostile to crypto. But is that changing? We know that all the banks have got blockchain teams. You're both part of this evolution. How serious is this? Okay, just by way of background, we learned quite recently that ABSA's developed a partnership with Ripple for digital custody. Nedbank seems to be opening up accounts for some of the CASPs, which was very unusual. Still, there are some banks that are very resistant to this. Where are we at?
Look, I think we celebrate what the other banks are doing because it's a collective. I think much of blockchain is about an industry moving together. Much of the change that's going to need to be effected is going to have to be wholesale across a number of different entities. So we fight, I must be careful now. We as blockchain teams within the banks face many similar challenges, so we celebrate one another's wins. And I mean, banks are large conglomerates of people, and it's about swaying the majority. And I think we're on the precipice of a 51% attack. So yeah, I'd say things are changing.
Over to you. Where are we at?
So I think it's like a natural progression for the supply to meet the demand, where the demand is and where the demand is going. And watching the crypto market mature and evolve over the past 10 years or so, it shows us that there is a place for these cryptocurrencies in the world. And it's important that companies like banks, who are quite strictly regulated, enter that game in a way that creates more safety and responsibility for consumers in a very balanced fashion, whereby they don't necessarily encroach in other people's market share, but making sure that you are giving the customers what they do need, especially with the younger generations, because, for example, Gen Z are the first generation of mankind who don't know a life without the internet, right? So they're coming up with their native crypto holders, and Gen Alpha will be, maybe having a lot of asset bases in crypto. So it's very important for institutions that are actually regulated and have a purpose to drive responsibility to be custodians alongside other players for the consumers in the market, especially the future generations.
I guess it's fairly logical that banks would be interested in this because the stats show that more than half of South African adults have at some time owned crypto. You cannot ignore that market for much longer. The question then is, at what point do they enter? Are they going to enter offering wallets, custody of digital assets, and we use that term very broadly, or are they going to be on your FNB app? Will you be able to buy Bitcoin? Rikki.
So I was at a large international conference a couple of years ago, and even amongst crypto maxis, there was a sense that there were only 2 instances of real product market fit within the crypto space. The first was Bitcoin as an investment product, and the second one was stable coins for payments. So if we use those 2 and we draw from them, banks are really interested in giving clients access to products they wish to invest in. Secondly, I don't think we can ignore stablecoins, and other variants of digital cash, including tokenized deposits and CBDCs, and the role that they will come to play in payment systems. So we are very heavily involved in each of those verticals. It is behind the scenes, it's bubbling under. We hope to make some announcements in the near future. Some of it is no surprise. FirstRand was announced along with ABSA as two South African banks involved in SWIFT's modernization program, including blockchain and digital assets. So payments, investments, and then there's a third vertical, and that third vertical is quite broad. It's all manner of things, including the tokenization of financial instruments, digital identity, putting real-world assets on chain. It is underappreciated, I believe, how much opportunity there is to make an impact there. And we've been scurrying away in the background for a long time. Much of that advancement does depend on new regulation and legislation and/or governments weighing in and giving their endorsement to products. So it is slow going, but it's coming.
Mohil, the same question for you. And I want to add to that. Are we going to see competition between crypto exchanges and banks, in your opinion?
So I think as time goes on and the banks have pressure to retain customers who have non-fiat assets, there would be natural competition between the exchanges and the banks as to who owns the customer, who owns the wallets. But the way it plays out will depend largely on how they partner within the ecosystem. So either you're going to compete or you're going to partner. And if you really want to evolve together, and because exchanges have different reasons for existing versus banks, right? They do perform payments, they have custody, but also banks have much more than just that, right, that they offer out there. So being able to collaborate in your ecosystem would be quite important to move forward to prevent aggressive competition and have more of a symbiotic relationship between each other, leveraging the best of capabilities that the exchanges have already built. Because again, maintaining an exchange isn't that easy, especially with wallet and cold wallets, etc. And then again, for an exchange to have banking capabilities, it's a whole different board game, right? So almost like what's the best of both worlds and how do you work together to prevent that pressure of competition and any potential extinction?
So are we going to see, Rikki, a merging of the crypto and the traditional finance space? And where do you see this barrier, this separation between the two? Maybe give us some idea of what the future will look like.
So I think regulation is always the kind of key for how far the banks would go in collaboration, or the extent to which we see a lot of crypto innovation being subsumed into financial market infrastructure. So it's undeniable that digital assets and blockchain will offer potential improvements on the way we deliver services today, whether it's speed, programmability. You guys know the play, you've heard it all before. However, there often are overlays in terms of regulation and let's call them jurisdiction-oriented restrictions, which make activity only possible within a particular country. That will limit the extent to which we would go full degen from a banking perspective, right? I think that's critical. So banks are not averse to the technology, but it does depend on, I guess, the palatability from a regulator's perspective and the ability then to enforce the same measures that are applied to traditional rails that will chart the path as to how much and how far banks will go.
Mohil, I mean, we see JP Morgan entering the space as, offering ETFs in the crypto space. Quite expensive, 1.5%, between 1 and 1.5%. There's clearly a lot of money to be made in this space, but they're going for the easy pickings, aren't they? Because their clients are demanding access to this new asset class. They're providing it at a price. But I think what the retail investor is looking for is a little bit more utility. They want to be able to pay. They want to be able to maybe spend some Bitcoin. And they want to be able to store stable coins. And we've heard quite a few of the presentations today talking about who's going to win this race in the stablecoin race? Is it going to be Tether? Is it going to be USDC? We've got some Rand stablecoins. Are we going to have all of these conveniently located on a single wallet? And how are we going to get people in the country, in South Africa, to adopt this? These are big challenges. I mean, if you try to transfer from your Luno account or Valor account to a decentralized finance wallet, it's complicated, and a lot of people have lost a lot of money. Somebody's got to solve these technical problems.
Thanks, Ciaran. So the consumers of the markets tend to move towards the path of least resistance. And this is why it's important for the FS providers to understand what type of transactions those consumers will want to have in the future, whether they are retail or they're commercial. And how are they going to want to transact? So if you in supply chain and you have cross-border payments, etc., do you want to just pay the supplier and the FS provider will find the right blend of fiat and crypto, offshore fiat, etc.? That system in the back end needs to be able to determine that and do it for you, right? So the person paying or the entity paying shouldn't need to worry what's going to be used to pay. It's more of an enablement at the back end. Hence why the FS providers need to understand what is a potential demand for payment services and how do they mix it at the right way, whether they're using AI or they're using this or that to determine the right mix and the risk criteria. And again, back to the other point of accessibility. So a good example in the AI field, to use Gen AI 2 years ago, you had to have a ChatGPT account, etc. Now it's it's in WhatsApp as Meta AI, right? So how do you increase accessibility to the right tokens and payment rails and coins, etc.? That should be up to the FS providers and how they determine to make it available to the consumers. And they need to do an entire assessment of the risk and how interoperable it is with other payment providers overseas and locally, so that when you just want to pay something, it happens in the most balanced way, and you don't need to worry about losing money in transferring, losing in arbitrage, for example, timing differences, gas fees. You just want to do the payment, and you want the best, most efficient way to do it, and the FS providers need to build that into their roadmap of how they're going to build systems to provide that.
Okay, Rikki, back to you. I want to change gear here a little bit and talk about quantum computing. Quite a lot has been written about that and the threat of quantum computing to the Bitcoin network. But there are other threats as well that come out of quantum computing. Just touch on that if you would.
Sure. So quantum computing effectively moves away from kind of 1-0 binary to a graph where it effectively enhances the computing capability, right? And the risk is that quantum computers threaten the cryptography that underpins blockchain. So the cryptography is a fundamental tenet. If it's missing or compromised, you challenge the integrity of things like the ledger of transactions that are committed, the notion of a golden source. So it really is an existential threat to blockchains. What I would say is that there's a sense that that threat is a real one, but the time before it becomes imminent, people are unsure about. Estimates range from a handful of years to a couple of decades. Nonetheless, many attempts have been made to ensure that the algorithms that are now being used are post-quantum encryption or post-quantum cryptographic algorithms. So there's this protection mechanism in anticipation of what might come in the future. However, a lot of legacy wallets remain susceptible to that threat, number one. And then there's also another vector, which is where data can be harvested now in anticipation of quantum computers in future being able to unlock or break the encryption that exists today. So it is incumbent upon wallet holders to check the statuses of their wallets. Also, in terms of protocols and so forth, this is being built. This modernization and protection is being considered by foundations, by the protocols themselves. So it's more on the wallet side, I would say, that you need to worry about things. And hence, if you've been sitting and hodling for a while, just double check.
I think the speed with which AI is developing gives us a sense that the Moore's law effect. We're getting this accelerated advance in technology. While I don't see there's particularly a threat to the Bitcoin network in the near future, certainly to wallets, there's a threat. So we're going to see a lot of encryption, better encryption, being built into wallets in the future. Would you agree with that?
Yes.
Okay, Mohil, and we're going to wrap up here. What is the future of banking? What is the bank of the future going to look like?
Yes, thanks, Ciaran. So basically, if you view a bank as an enabler to your business, your lifestyle, and what you're doing, you really want to be able for your bank to do things on its own, right? Predictively, prescriptively, not just proactively. We're going to move forward from proactive to being predictive and prescriptive. Therefore, the data that they collect about you should be able to enable your business better and faster, and therefore it becomes ubiquitous, right? So ubiquitous banking means it's all around you. You just walk into a coffee shop, and by virtue of the fact that they know your face, you just walk out the coffee and it gets paid, right? So the future of banking would be where we have a convergence of, potentially blockchains with AI, with quantum cryptography, et cetera, so you're more secure, to the point where you just live your life and it just happens for you. It's also at a point where it should be, the bank should be advising you on what to do, as opposed to you go to them. So instead of you go to them, they come to you with suggestions, and you have targets that you're going to meet, your budgets, your loans, your house, et cetera. It should be able to tell you proactively, this week you have this much to spend if you want to get this goal, and this is the reward for doing so. But almost as a sort of guardian angel behind the scenes that's going to be monitoring what you're doing in a safe way that's going to enable your goals and objectives to be met, as well as making sure that you are seeing tangible progress in your life and in your business week on week, month on month, year on year. So the whole data game, how do they analyze the data and compare it to what's happening in the market, and also making sure that there's mechanisms to prevent unforeseen circumstances from happening, they should be able to let you know. So as a data provider, data custodian, they should be able to enable you for your future.
Rikki, I want to ask you the same question, the future of banking, just where we've seen in the last 100 years this kind of wild experiment in money. And it really originated out of the Federal Reserve Act and the central banks forming basically a cartel to set interest rates. That is now under some kind of threat because you've got competing monies. And if you go back into the 19th century, the 18th century, every bank would issue its own, for example, US dollar. And in South Africa, we've had the Rand, I think, in existence since 1961, over which period of time, by the way, it's lost 99% of its value, believe it or not. So what are people doing? They're switching into stable coins. Stable coins themselves have lost 98% of their value since they became, since you had the unified dollar of 1913. So you are going to have more choice in where you can park money, where you're going to look for stability. Bitcoin probably, a lot of people will say, that's the safest bet. But give us your vision of what kind of a future are we looking at with banking?
I mean, I think that Mohil addressed the banking question for most part. I think that banks, there's been a lot of change, and you've alluded to things like the fact that you had this proliferation of US dollar issuers in the past, and that was all then coalesced, and there's only a single dollar issued by the Reserve. You've spoken about things like inflation. I think banking services have evolved over that time, but they primarily are around lending, borrowing, transactional activity, investments, insurance. I don't see that changing that much. I see enhancements due to the uptake of blockchain and digital assets. I think that the experience element that was alluded to by Laverne, I think it was from Mohil's team earlier, regarding your engagement with a bank, that it's proactive, that it might be voice-oriented and not as kind of user-driven as it is today. Those experiential things are going to come to the fore. But the basic building blocks of banking, I don't see fundamentally changing, hopefully enhanced. hopefully more embedded and abstracted away. So it's really about the user intent being paramount, and banks being able to respond to that and elicit and optimize.
Right, and of course banks have a very good track record in digital custody, so they have a bit of a head start. But can we open this up to the floor? We're going to wrap this up if we've got any questions. Yeah.
Sorry, I'd just like to get your perspective on Bitcoin as a store of value, because it has revolutionized currency as we know it. There's no countering its CAGR return since its inception to where it is now as a $2.2 billion asset class. There's just been no other compounding return outside of maybe some Max 7 initial launches. And what's happening is, as you've alluded to, there's a devaluation of Rand and then dollar as well. And people are figuring this out. I mean, so much so that JP Morgan are now alluding and telling their clients to allocate 2 to 4% of their total investable market to Bitcoin directly. And they're calling it the debasement trade. They literally are referring to it as that. So I'm just saying, how is it, you know, people now have a real, for me, if you view Bitcoin as this revolutionary, you now have a store of value, but it's not only Bitcoin. If you look at, and as was alluded to in a previous presentation, you could have just held a basket of whatever coin and you did a 600% return. There's a lot of asset managers over a 10-year period that are going to be sweating to get that kind of return.
Yeah. Rikki, do you want to take that?
Not particularly, no.
Mohil, you want to take that?
I mean,
I could try. So I think looking back, you can say it was a store of value. Looking forward is difficult to determine because it depends who's holding it, right? At the same time, Bitcoin itself, for me personally, the value is the fact that it's immutable and the data will always be there, right? So that data of transactions you can't really change unless you have a very powerful machine that can fool the blockchain for a couple of hours, or quantum computing comes around and then could change the actual thing. Because once it happens, if there's ever a time where the security of the blockchain itself is under threat by quantum or very powerful supercomputer or a conglomerate of 51% of miners, then Bitcoin might not be worth anything, right, at that time. So the idea of a store of value, it's actually the value that it has is the immutability part. And as long as the democratized holders of that transactions find it valuable, it'll increase in value over time and it'll fluctuate. But at the same time, it's very hard to forward think and say it'll always have value. Looking back, you can say it, but looking forward is difficult because of potential threats. Also, we don't know who are the biggest holders of this coins and what they're doing with it. And we as a society of mankind, we don't really know how does peer-to-peer currency networks actually work and self-regulate. So that's what it actually is, it's a peer-to-peer currency settlement system. We'll find that out as time goes on. But that's the best I can give you an answer at the moment, yeah.
Yeah, and I would say that fiat is, where things went wrong was in the, post-Bretton Woods, 1945, after the Second World War, where the US dollar was pegged to gold and all other currencies were then pegged to the US dollar. So you had an indirect peg. For example, at that time in South Africa, it was the pound indirectly pegged to gold. That was removed in 1971. So as soon as you start doing that, you encourage recklessness by governments all over the world to spend their ways to all kinds of ridiculous boondoggles. And that, so that, Gresham's law, that good money will drive out bad. And Bitcoin is good money because it was thought about from the very beginning as anti-inflationary. And, the network effect will eventually take hold, I think, and you'll get bad money driven out. Do we have another question there?
Right. Thank you, gentlemen, for sharing your insights. It's very, very informative. My question is more on the CBDCs, because I can see the positive side of things, how it can happen and how it can actually empower citizens and everyone. But my concern is also, because I don't want to turn a blind eye, because there's always two sides of the coin, right? The good and the bad. So now when things really get bad in the wrong hands, would it be possible to like start seeing CBDCs that have timestamps where like dictatorial type of way to control society? Like if you don't spend your stable coins by a certain time, it'll expire. Do you think maybe certain things could possibly be there? Because in that sense, looking at the history of where we've been with corruption and all that stuff, it kind of also builds a sense that would it also be building an illusion to the public that it's decentralized, but certain aspects of it are actually centralized? Do you see that happening in the near future?
Sure. I think by definition, CBDCs are issued by a government and or central bank, right? They are centralized. And the biggest threat to their adoption is the fact that your activity is imminently viewable by the government and could be weaponized against you. And there's some safety measures that have been mooted that could ameliorate that risk. But I think anyone with a maxi or a decentralization mindset is going to be averse to it. I think that there will be pressure from some central banks to issue. It need not be on chain, so that should alleviate some of that oversight consideration. Personally, I think stablecoins are way ahead in terms of retail adoption. It would be hard for tokenized deposits, let alone CBDCs, to displace that. But again, if you have government duress, you could see CBDCs rise in prominence. My preference would be to see CBDCs in the wholesale space rather than retail, and leave the retail space to tokenized deposits. Sure. So wholesale would be interbank settlement, pretty much payments between financial institutions. So if you think the parallel in South Africa at the moment is when banks move money between themselves, it's via SAMOS. So that sort of setup, I believe, is one well set up for disruption from a CBDC.
Great. Thanks very much to both of you. Thanks to all of you for coming.
Thank you so much. Thank you very much.